Hi everyone, it's your daily 10-minute business and finance news wrap for this Friday, the 19th of November 2021. Later, how to invest in an inflationary environment. But first, to Crown, it received another takeover offer just 4 weeks after the Victorian Royal Commission. This one is from US fund manager Blackstone. It's the company's third tilt at the casino operator at $12.50 per share. Back in May, it offered $12.35, and in March, the initial offer was $11.85. How does it stack up? For more, here's Mathan Somasundaram from Deep Data Analytics.
Yeah, look, Crown is in a great place for a takeover. The management has obviously had the issues, regulatory problems, multiple states. So the takeover makes sense. They need a clean sweep of management, get new management in. And so the takeover generally sits well, but individual states have to approve it on a regulatory basis. So that'll delay the approach. But I think eventually they will all support it because they need the employment and they want the taxes. On the flip side, you've got major shareholders. My guess is they probably want something with a $13 or $14 in front of it. So Blackstone probably need to do one more step up. But I think it's inevitable someone's going to take it out. And the regulatory problems will probably hang around for 6 to 12 months. But they're willing to put up with it because of the discount. Oh, they're great assets. I mean, these are great utilities. They just don't sound good because of the media coverage that's played out, but they're solid cash flow generating assets. So, look, everyone would want to buy it as long as when the dust settles. So what Blackstone is doing is the smart thing. They'll probably pay up, but it's going to take a bit of time to clean through the regulatory requirements.
Mathan Somasundaram there, and Crown shares rose 16.5% today, the best performer on the 200 to $11.54, so below that $12.50 offer price from Blackstone. The Australian share market today rose just 0.2%, 7,396 on the S&P ASX 200. For more on the day's action, I spoke earlier with Marcus Bogdan from Blackmore Capital. Marcus, what's driving the market today?
I think there's three key themes which have been driving the market. AGM season and giving us updates. So Sonic had a very good result. The second thing is M&A activity. We've seen it with Crown, we've seen it with Treasury, so that's driving some stimulus into the market. And the third element is a recovery in the materials and the energy space, which has been under pressure in recent weeks. So that's recovered. But it's interesting because it's a barbell. You've got the resources and the energy recovery, but on the other side, healthcare and consumer staples are doing well, which are more defensive.
Okay, one sector which has been smashed this week, it's the banks, right? It follows CBA concerns over margins, even though its profit number $2.2 billion cash for the quarter. What's your take on the sector?
Well, I think the announcements from Westpac and CBA were disappointing. And that's despite the fact that we've got incredibly strong conditions in housing. We've got buoyant housing lending. We've got a re-emergence of business lending. The banks have got very, very strong capital positions, and credit quality is strong, and household savings are also high. But margins and expenses are the two factors which are weighing on the banking sector. Margins are under pressure because interest rates are at record lows and there's greater competition, particularly in housing. And then the expense side has been far more persistent on the banks. And I do think that those two elements, both the margin and the expenses, will continue to weigh on bank results.
That's even as interest rates, I guess, may potentially rise, right? What's the market now saying about earlier than expected rate rises, despite the RBA's constant assurance that it won't happen next year? We heard from the RBA again this week.
Well, you're right. The RBA have again reaffirmed that 2024 will be the time when interest rates will potentially lift off. But I do think that they have to be far more dynamic. It is absolutely evident that central banks have been behind the curve in terms of anticipating this higher inflation. The higher inflation hasn't been transitory. It's becoming more structural with rents, with labour. And so all of those things I think that the RBA has to grapple with and they have to be attentive to that. And so I do think there is a likelihood that they will have to move earlier than the forecast of 2024.
So does that mean you're seeing inflation becoming a bit more entrenched? And if so, has that changed the way you're investing?
It's very clear that through supply chains, inflationary pressures are very much present. At the moment, companies have been able to pass on those higher prices to the end markets, and so we want to be invested in those companies that do have pricing power, are industry leaders, and if interest rates do start to rise, it's incredibly important that those corporates have very strong balance sheets.
Just finally, if we can talk about Evergrande, the embattled Chinese property developer. It's rumbling along. Yesterday, S&P said the company would likely default. What's your view on the whole situation, and is it something that you're concerned about?
Very mindful on it for a couple of reasons. First, China is such an important component for global growth and global perception. So this has to be managed. I don't think it's going to be systemic outside of China. And I do think that the Chinese authorities are trying to moderate growth in their economy. And they are doing that by pricking some of these asset bubbles that have formed. And so I think it will be managed, but the corollary of that is we're going to have a period of more sustained and lower growth coming out of China.
Marcus Bogdan there from Blackmore Capital. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.